Good evening, ladies and gentlemen. Welcome to our first MPM Insight series with Frank Weiss. Today we're going to be talking a little bit about real estate, and we will be doing some other business topics throughout the next couple weeks, months. So stay tuned. We'll be covering finance, operations, a little bit of everything. So thanks everyone for joining, and my name is Michael McQueenie. I am the founder and CEO of MPM Strategic Group. I've worked for over 10 years now in many corporations, from startups to IPOs to even leading Fortune 500 companies. And of course, I also have experience in real estate as an active investor and also just, buying my own property. MPM Strategic Group is a consulting firm that specializes in strategic planning, finance, business formation, development. We also do market research and also cover taxes, accounting, and so much more. Our team of experts help entrepreneurs, startups, and small businesses achieve their goals faster. We also help drive growth and innovation through data-driven strategies and technology. That said, I am thrilled to announce our guest speaker for today, Frank Weiss. Frank has a solid background in real estate development and construction, and has worked on several large-scale projects working at the Related Group here in Miami, and just recently also graduated from MIT with a master's degrees in real estate development. We're excited to share some insights with you on the current market, discuss some investment strategies for all of our audience today, so hopefully you'll get some good insights as we go through our discussion today. So Frank, can you tell us a little bit more about yourself? How did you get into real estate?
Yeah, absolutely. Well, first of all, thank you for having me here, Mikey. I'm very excited to be speaking with you, and I'm also looking forward to these upcoming industry insights that you're going to be having. And also, I'm very grateful to be the first guest for this series. So with that said, I actually come from a construction background. I studied construction engineering back in undergrad, and shortly after that, I started my first job out of Chicago working for Related Midwest, where I was working as a construction manager. But I actually knew shortly into starting my first gig that I wanted to transition or pivot into real estate development. So I decided to pursue my master's in real estate development at MIT, and I'm happy to say that I just recently graduated in December. And since then, I've been working at the Related Group as a development associate on the condo division. And, I'm very fortunate to be living here in Miami and working for one of the most active developers. We have a very robust pipeline, and I'm really looking forward for the next couple of years.
That's awesome. So let's start by discussing real estate today. As you know, the overall market, it's seen a huge amount of growth in the recent years, with demand for both residential and commercial going through the roof. Factors such as low interest rates, population growth, urbanization, this has all contributed to this trend. So Frank, can you help elaborate on this trend and maybe give us some more background on the historic market performance?
Yeah, absolutely. So I think you bring up a great point with regards to historically low interest rates. So we've been very fortunate this past cycle where we've seen low interest rates paired with a lot of investor appetite that has put some upwards pressure on real estate prices. So it's been a good last cycle. But I think right now we're in a little bit different place than we were a couple years ago. So if you were to take a snapshot of where we are today versus say back in 2018, things are looking a little bit different. You well know, you've all seen the headlines that interest rates have essentially doubled in the last year. And interest rates tend to have a negative or an inverse correlation with real estate prices. So the math of that is essentially that when when interest rates go up, it becomes more expensive to pay your monthly payments on whether it be a house or an investment property and that sort of stuff. But again, that's more of a snapshot of where we are today. I think if you're talking a little bit more about history or forecasts, I think the $1 million question is, what's going to happen in the market? What is the market outlook? And what are we going to be seeing in the next couple of years? And while I'm not an expert, nor do I think, forecasting is something that I people should be putting too much attention into. There's definitely something to be said with where we are today. And I think there is a good term, and actually if I can take it even a step back more, if you're going to do a good forecast, I think the first thing you need to do is you need to look backwards in order to look forward, right? And there's a good term that I think does an excellent job at explaining this, and that term is known as mean reversion. So essentially what mean reversion states is that markets are cyclical, and there tends to be an average or an average historical price. There tends to be a trend line within those cycles. And what mean reversion says is that anytime that the prices are trending above or below the historical trend lines, prices are going to want to revert back to the mean, or in other words, what you hear a lot in the news headlines is going to be that the market wants to correct itself, right? So where are we kind of now? And I think if you were to look, for example, at the Case and Shiller Home Price Index, if you were to look at it in 2023, you would be able to see that we are trending slightly above the historical trend line. And again, if you believe in mean reversion, or if you believe that history repeats itself, what that indicates is that there's probably going to be a market correction. However, I do want to give a big disclaimer on this because, first of all, you need to understand that real estate is a little bit of a random walk. There's too many unknowns, in my opinion, to accurately or to be confident in what the forecasts are. So I don't like to pay too much attention to the forecast, but it's good to understand how they are. And then the second thing is, and then I think this may be more relevant to someone who's trying to buy their first home or to buy their first investment property, is I would really caution against trying to time the market. I think if you're a new investor, or, for lack of better words, if you're an unsophisticated real estate investor, I think you would be doing a disservice to yourself if you're trying to time the market. If you're new to this, I think you really only have two outcomes if you're trying to time the market, and those are you're either going to be catching a falling knife, or you're going to be too late to the game. And if I can kind of maybe put one slight piece of advice to this, is that, or maybe what I'm doing right now is I'm being more patient right now, but at the same time, I'm not sitting down the sidelines and not looking at deals. I'm being patient, but I'm also being as resilient as possible. And what that means is that you have to be disciplined. Right now, don't focus too much on forecast or where the market's going on. You have to be an active player at any given time in the cycle. And if you do that, I think, and you focus on the fundamentals and you look at a deal, by its true assets or its true value attributes, then I think if you can make a deal work today, that deal is probably going to work tomorrow as well. So I would stick to the fundamentals, look at it on a deal by deal basis, and maybe don't worry too much about the headlines and the forecast and bubbles and all that sort of stuff.
That's really good advice, Frank. And so maybe moving on from a more macro level overview and understanding the market. So what does this all mean for our viewers who are maybe trying to buy their first home, or maybe do their first secondary home or investment property, maybe looking at a market such as Miami?
Yeah, my favorite market. So yeah, if you were to zoom in and kind of look at where we are a little bit more on a local basis, I think Miami has also indulged in a little bit of these low interest rates, but also Miami has seen a massive influx of people moving into not only Miami, but the state in general. You're seeing a lot of people moving outside of states such as New York, Illinois, and California, and that has actually exacerbated or put more upwards pressure on the appreciation of real estate assets. So what does this mean if you're a first-time home buyer or you're trying to buy your first investment property? Again, look, the reality is that it's going to be a little bit more challenging. Things are more expensive. And also there's a lot more competition. So with that said, even though I think it's a little bit more competitive to look at Miami right now, you definitely still have to be looking. And what I'm doing is I'm probably looking at some neighborhoods that may not be considered core or as desirable. So look outside, look at places where there's a little bit less competition, but also at the same time, you gotta realize that real estate is a long-term asset class. I think we're in a good place in Miami, so I don't want to dissuade anyone from telling them don't go out and look at deals. At the end of the day, I think Miami has some of the best fundamentals in the nation. I'll just name a few of those. And I mean, Miami, everyone wants to live here. I mean, just look at the weather. You look outside; it's always 80 degrees. It's summer year round, right? And actually, one of my criteria after graduating from MIT, it wasn't so much just doing real estate. My criteria was I want to live in Miami, and I feel that I'm not the only one doing that. There's a lot of people that are following that, and there's a lot more people that are going to keep coming to Miami. In addition to Miami being one of the best cities to live in, there's also some very favorable tax incentives. I'm no professional when it comes to taxes, but we all know that Miami, I believe, doesn't have it has no state income taxes, so that attracts more talent, more people to want to live here. And then the last thing is that Miami, or at least the administration in Miami and in Florida, I think is more aligned with developers and people in real estate, in the sense that they are more willing to approve or more willing to be pro-development, And what does that mean? Right now, everyone talks about an affordability crisis. Everyone talks about a housing shortage. Well, one of the easiest ways to fight those things is to have an administration that is aligned with developers and that allows us to build a little bit more of that supply so that we can kind of mitigate that gap and that housing shortage. So look, I think Miami is here to stay, and again, even those things are becoming a little bit more challenging, I encourage that you look where less people are looking, but still know, or at least my opinion, that Miami is a good place and it's going to stay here for a while.
Absolutely. It's really fascinating to see how these trends continue to shape the market here in Miami and elsewhere in the U.S. and even in Puerto Rico. Moving on, I'd like to know, looking at areas or neighborhoods that are experiencing significant growth, how do you know which ones are worth looking at? How are you able to find good deals?
No, that's an excellent question, actually. And I think, one thing is growth, and then the other thing is the price is right? So right now, maybe I'm not going to focus so much on where I'm looking at, but I can tell you where I'm maybe not looking as hard as I used to. So right now, I'm probably, I don't want to say avoid, but I'm looking less at some of those more desirable locations, more core neighborhoods such as Brickell or Coconut Grove. And it's not that I don't love those places. Believe me, I'd love to live in Brickell or Coconut Grove. Our office is actually down in Coconut Grove, and I think it's fascinating there. But the problem with those neighborhoods is that there's a lot more competition. There's a lot more eyes looking at any given deal. So I like to focus in some markets that there's less competition. And before I get into those markets, I want to add one more thing on why maybe I'm focusing less on some of those core or more desirable locations. And the reason of that is like I said, a neighborhood is only as good as the price that it has, at least for me. And if I'm looking to invest, right? And, when you're looking at Brickell, for example, you're competing against what I call, a little bit of stupid money. There's just a lot of flight capital, and you have, me competing against perhaps a very wealthy Argentinian family that doesn't mind paying a premium on a property in Brickell because their money is safer in a condo in Brickell than it is in the bank in a high inflation nation somewhere in South America. So with that said, where I'm kind of putting all my marbles or putting a little bit more of my focus is going to be in those neighborhoods that has less competition. You want to look at You want to be able to look at places where other people may not see the value, but you do. And, some of the neighborhoods that I really like are going to be Doral or even Hialeah. And what I think is fascinating about those neighborhoods is that, we're actually here right now in Doral. And sorry I was a little bit late, but I had to turn around and go look at all the neighborhoods because, I want to move around here. I think, the quality of life that you get in these neighborhoods is very comparable to that you're going to be getting in Brickell. A little bit less traffic, actually. So, some may argue that this may be a nicer neighborhood to live in. And the other side of the coin is that you're going in it at a much lower basis, right? You're not competing with this stupid money, or you're not competing with people who are willing to just put in whatever price because they want to have a place in downtown Miami or in Brickell. So again, maybe focus on looking at those markets with a little bit less competition. That's what I'm doing, at least.
Less competition, less risky, right? More potential for some upside down the road. So Frank, can you tell us a little bit about how you tend to look at a deal? How do you know if it's a good deal or not?
Yeah, no, absolutely. I think that's really the $1 million question, right? And there's a couple of different facets. One is how do you look for deals, or how do I look for deals? And the second one is how do I evaluate and how do I make sense out of a deal, or at what point do I say, okay, this is a good deal, I think I'm going to put an offer into this deal, right? So the first one is how do you look a deal, and I don't want to repeat myself too much, but at the same time, it's right now, at least what I'm doing is I'm trying to be creative and, again, be patient and resilient. So what I mean by that is in terms of being creative is you got to look at some different markets that other people are not looking for. And again, look at those deals where other people may not see the value, but maybe you do, or maybe I do, right? If you squint your eyes hard enough, maybe you can see this is going to be a good deal for me. And what I mean by that is, like if I get a maybe not a brand new condo, but if I get a condo that has been recently renovated in what's known as a desirable location, I may actually skip on that deal. And the reason for that is because I don't want to necessarily pay a premium for work that someone else did, and that work which, we can do. And I think actually to that point, if you're a young investor, or if if you're not married, and if you don't have too many responsibilities, for lack of better words, I think that's a little bit of a competitive advantage. So I like to look at properties where I can add some value. And by value, it doesn't have to be anything too extensive, right? Just look at a property that maybe needs a fresh coat of paint on your first deal, maybe on your second deal. Actually, one of my go-to renovations is changing the hardware, changing the light fixtures, and changing the outlets. If you get those kind of switch outlets, I love to change them to the more seamless outlets, or electrical trim package, as we call it.
Right.
And looking at those little things, and then down the line you can start staining floors or adding backsplash. But I think that's really, if you're young and maybe don't have many responsibilities like I do outside of work, kind of that's your competitive advantage, and put that value add and that sweat equity into the property. So that's one thing. I also, you got to be resilient, like I've said a couple times, right? And what I mean by that is I like to spend, maybe not an hour, but a couple minutes every single day on Zillow. And not just Zillow, there's many different search engines that you can look at. There's apartments.com, realtor.com. You can actually reach out to people like yourself that may have contacts, or may have access to the MLS, or can guide you through a couple of off-market properties. And the more you look, the better your odds are. And once you look at deals every single day, you can get a little bit more creative. And every once in a while, I'll start looking at deals in Zillow where I'll sort them maybe from oldest to newest listing. So a lot of people tend to always go to the newest listing. I like to look at those properties that maybe have been sitting in the market for a while. Maybe they've been on and off. And at the end of the day, I like those properties because maybe someone looks at a property that's been sitting in the market for a year and they're like, oh, something has to be wrong with it, so I'm not going to go look at it. And what does that mean? You have less competition or less eyes on that any given deal. Really, I would recommend you, if you see a property like that, go look at it for yourself. And, it may be one of the best deals you ever find. So be creative when you're looking. And then I think your other question was on how do you evaluate a deal? And, I think that's a little bit more a complex question. I don't want your audience to fall asleep and get too involved in the numbers. But, the first thing that once you've already done a little bit of your market research, more or less where you're looking, I think, this may sound very basic, but it's very important. I think this sounds much more in Miami, actually, where people love to, go out and spend that $200 dinner, or, buy a new car every year. What I like to do is I like to understand and budget. For the first thing, right, you got to do is you got to save a little bit of money. You got to know what you're willing to put in real estate. And once you know how much you have in the bank to invest in real estate, you got to understand how much can I afford on a monthly basis, right? So that's what I like to do. A quick rule of thumb that I like to use is, for example, if you have $100,000 in the bank, you multiply it by 4. That means that you can buy a property in the range of $4,000, and that's more or less what you can afford from a, I don't want to call it a static perspective, but from a, I'm buying this now. But then the second thing you got to look at is how much is this house going to cost me on a monthly basis? So understand what your carrying costs are going to be and what your down payment or your initial investment is going to be. Once you do that, you can start going into the more, what I call slightly more complex evaluation or underwriting on a deal, and kind of start penciling the deal. So once you know what you can afford, once you have an idea of more or less where you're looking at, you've calculated what your monthly costs are going to be, the first thing I do, and this is again, it's not one shoe fits all. I have one criteria. This criteria has been somewhat recent. I haven't done this in the past necessarily, but right now, personally, if I'm looking at a deal that it's going to cost me, on a monthly basis around, say $3,000, my first criteria right now is I need to make sure that deal cash flows from day one. So if there's $3,000 going out in expenses, I better have at least $3,100 coming in, and you're never going to be sure about that. Like I said, it's a little bit of a random walk in real estate. You don't know what the market's going to look in a couple of years, but my whole point is if that deal makes sense on day one, it's probably going to make sense in a couple of years. And once you've evaluated that, you've kind of crossed that checklist where you know what you can afford, you know what it's going to cost, and you know that your rent is going to exceed your carrying costs. The next thing I like to do is you got to set some goals, and it's everyone has different goals, right? You may be looking to buy your forever home. You may be looking to buy a property that you want to inherit to your kids. You may want to hold a property for no more than 7 years or around 7 years like I do. Also, you may just want to buy a property and flip it within the next year or so. I haven't done that yet, by the way. But once, like I said, my goal, right, is I like to hold a property for, around 7 years plus or minus 2 years. Let me add one more thing. You got to be flexible, right? These things can change.
Right.
But my goal is not only the duration, but also I have a personal goal where look, I'm not doing this for free, right? I wanna get an investment property, and my goal is I like to double my money every around 7 years. If I can double in 5 years, fantastic. But every around 7 years or so, and I understand that if you want to double your money in 7 years, that tends to result in approximately like a 12% annual rate of return. Don't want to confuse this with internal rate of returns and whatnot. This is simply you put in $100,000. You want to be making at least, I said 12%. You want to be making at least $12,000. I'll be careful by not saying clean, and I'll explain why in a second. I don't mean exactly clean, because the other thing is once you've established your goal, you gotta find the roadmap. How am I going to get to that goal, right? My goal is I want to double my money every 7 years. I need a 12% return. So how do I get to that goal? And, I think this gets a little bit more complex. If you're a first-time home buyer, this may not necessarily be for you, but I think it's good to understand what are the value drivers in an investment property. Mm-hmm. And, I think, again, you can use people like yourself to help you with the numbers and navigate through some of these they're not too complicated, but slightly more complicated, perhaps, equations, right? And the value or the value, where the value comes in investment properties for me, it's a handful of things. It's just one hand. There's going to be cash flow, right? So the metric that I use for that is going to be your cash on cash. It's whatever is left over after your expenses and your reserves. That's going to be, after your reserve, that's going to be your free cash flow, right? That's going to be part of the percentage that's going to get me to that 12% goal, mm-hmm. right? Cash flow. The second one, and this depends, what type of debt do you have? Are you doing a mortgage where you're paying principal down? For this scenario, that's what I'm talking about, right? I'm putting 20% down, 30 years, and I'm doing what's known as an amortizing. Sorry, I always butcher that pronunciation. But anyhow, it's a type of debt where you're paying down your principal on a monthly basis, right? And your equity is growing as the years progress. That's another place where you can get a little bit of that return. So, let's say on the cash on cash, you get, 2 to 4%, say, it's just kind of throwing some numbers out. It depends really on the market. Then on your principal or your gained equity, right? That's the beauty of rental properties. I'm going to rent it to someone else, but not only are they paying me, they're also paying my debt down, and that debt becomes equity down the line. So my equity keeps growing, and let's say I came in at $100,000, and a couple of years later, I've paid $20,000 down of my debt. So that's another piece of the puzzle to get to that 12%. So I have my cash and cash, and amortization, right? And then there's maybe three more, one with a little bit of an asterisk. You're going to have appreciation, right? whatever your property goes up by year, it may also go down though, so you got to keep that in mind. But that's another value or another brick in kind of that goal, right? And then one of the last ones is going to be leverage. So once you're just putting 20% down, you're obviously going to be getting, whatever the delta is, 80% from the bank. And as your appreciation goes up, it's compounded by the leverage. I'll give you, and again, sorry, I don't want to get too much in the numbers, but I'll give you a very quick back of the envelope example. I bought this house for $400,000. I put $100,000 down. This house is now worth, say, let's make nice round numbers for me, $20,000. So I sold it for $420,000. So that yields a 5% appreciation. But keep in mind, you only put $100,000 down. So it's really, you're getting $20,000 in appreciation on $100,000. So that's the leverage, right? It's the compounding effect of using other people's money. And then there's the last one, which is probably my favorite one, but it's hard to control. It's going to be value add, right? So like I was saying, this property, if I were to buy it today, I can rent it for $3,000, but I'm going to paint it. I'm going to put some backsplash. Maybe I'm going to add some cabinets or my favorite, changing the hardware. That's going to result in maybe an additional $100 a month in rent. And that you can add that to your bricks. That's going to get you closer and closer to your goal. Let me just say one more thing on how I evaluate the deals and which one takes precedent, because some of these value attributes are, for me, more important than others, right? Which are those? Those are the ones that you can control. Your cash on cash, your amortization, or what you're paying down in your loan, those are much easier to control. I mean, the bank's going to tell you after year one, you're going to pay this much in interest, this much in principal. It's known, right? If you can keep your rents at a stable price and have very little rent growth over a year, you know that your cash flow is going to be always X out of your expenses. Granted, there may be special assessments and all that sort of stuff, but that's why I kept saying, have some reserves in line. Yeah. But I like to focus on the ones that I can control. So again, right, you look at a deal, what you can afford, what it costs. If you can make a little bit more out of that monthly cost, you're good to go. And then set your goals, right? And my goal, like I said, is the 12%. And talk to people that can help you kind of get to your goal. And actually, if I were to add one more thing is you can always be flexible, right? Your goal may not always go as planned. And that's the beauty of real estate. Exactly. Yeah. So, let's say the market dips or something. And right now we're seeing interest rates that are, don't quote me on this, but I think they're trending above 7%. But let's say, I bought this house and 2 years from now, it may be a little bit lower. Well, maybe interest rates went down too. You can refinance. You can hold for longer. That's the beauty of real estate, right? So long as you're flexible, the deal is going to work for you, especially if that deal worked on day one, like I said.
Exactly. It's really great to have all these insights and really see all the metrics around, evaluating a deal, right? So let's move on. How do you then, once you decide you want to buy a property, you're going to commit, what does that purchase process look like? What are some of the elements that or steps that you kind of need to go through?
Yeah, absolutely. I think it's critical once you've kind of passed the checklist, right? Or once you've said, okay, the underwriting works, I'm ready. Let's go put in an offer, right? Well, let me take one step back again. There's always something before you need to, once you're ready to execute the deal, and now you got to do a little bit of what I'm going to call this time pre-due diligence, right? So if the deal makes sense or the numbers work, especially now that we're in Miami, I would, be cognizant at least of some of the risk factors that may be involved. I know Miami is very prone to climatic risks. So maybe just double check, is this property in a flood zone? Has the roof been replaced? And that sort of stuff. Just do a quick due diligence on your own. You're going to have people, and you can always call people to help you down the line to do that. But now you've done that. The deal works. Okay, let's submit an offer.
Sorry to interrupt. Do you then, there's a lot of brokers here in Miami, right?
Yeah,
Real estate brokers. Is that something you recommend? Do you go by yourself? Do you, hire someone else? What do you think?
That's an excellent question, and I have a couple mixed feelings on that one. I think kind of my educated investor advice would be potentially to look at a broker. But like I've said before, you got to be creative right now, right? And sometimes the difference in a broker can be what makes that deal pencil for you. Do keep in mind your options though, right? If you're a buyer, odds are the seller is going to pay for your broker fee. So maybe if you're going to be a seller, you may want to get a little bit more creative when it comes to owner financing or some other strategies. I haven't personally done a deal without a broker, but I know that there's options. And like I'm saying, right now you got to be creative. So no, I think that's a really good point. And you got to evaluate your options, right? I think brokers are definitely going to give you some good advice, but there's also other people that are really involved in real estate. And if really the broker is what makes the difference, maybe it may not be the right deal, but at the same time, if you can save a little bit of money and maybe put it into that value add, and you can get a higher return out of that, that's up to you. So that's a great question. I mean, it's definitely an option, and like I said, it's good to know your options. Moving more so on the purchasing process, right? So you've submitted your offer, you've decided, let's go with a broker or without a broker. What comes next? Again, there's always something that comes before that. One thing that I like to do is, make sure that you've had the money at least in your bank account for at least 60 to 90 days, because the closing process is very tedious. So be prepared for that. That's going to come down the line. But now you've submitted your offer. Let's say it's been accepted. There's been a little bit of negotiation. At this point, you've probably only seen the property in an open house or with your broker or by yourself. If it's an off-market listing, maybe you know the person or whatnot. But once you've submitted your offer, you gotta make sure that in your offer you have a couple protections, right? There's many of these. You can always consult with other people and ask them for them. But some of the basic covenants or line items that I like to put in a contract, or I like to ensure that they're there, is if I'm going to finance this property, number one, this needs to have a mortgage contingency, right? What does that mean? If I don't get my mortgage, I'm probably not on the hook to buy this house. Number two, an appraisal contingency. So let's say you put an offer for $400,000 and the bank inspector comes in and he says, sorry, this house is worth $380,000. Now you're protected and you don't have to necessarily go with that deal. So you want to give optionality to the buyer in case something comes up in the due diligence and closing process that you can still pull out of the deal. So make sure you have a strong offer with optionality, or some risk mitigating factors, which in that event is going to be a couple of these contingencies, right? Right. And that's really when it comes to submitting an offer. And afterwards, depending on how fast your closing period is, typically it can be 30 to 90 days. It's really case by case how strong your financials are and how competitive the market is. But once you do that, you gotta have an inspection, right? And there's some stuff that I've done when I have an inspection, and you can further negotiate a little bit more once you have an inspection. I think you can walk the property, you see that the windows are not working, or look, I got to fix the AC, and this was something that you couldn't see from the initial offering or when you first walked the home. So you're now really looking at the guts of the property that you're looking into, and make sure that you have a really good inspector. If you've worked with other people, or if you have other people that have bought properties, they have a good recommendation, this goes a far way. Yeah. I've seen inspectors that will walk a property in half an hour and they'll miss a bunch of stuff, and I've had inspectors that love this stuff, and they'll go there for 1 hour, and it's gonna result in potentially a $5,000 or a $10,000 credit. And the beauty of the credits is that you can use them in multiple different ways, right? You can put less deposit down. You can maybe, and it's not something I would necessarily recommend, but you can probably put it against the purchase price. So let's say the purchase price is now a little bit higher, but you get the credits. So what you're netting or what you're actually paying is going to be the same. But when you go to sell that property, someone's going to look at that property and be like, oh, he paid a little bit more for that, right? So when I'm getting that appreciation, it's better to get 2% out of $420,000 than 2% out of $400,000, right? So that's a little bit of the inspection process. And I think from what I can remember, at least, those are the places where you need to be the most active. After that is going to come the underwriting process from the bank or from the lender, right? And this is, it's the first time you do it, it's a little bit tedious. They're going to ask you for a lot of questions, right? Like, where do these funds come from? How much do you make? Do you have any outstanding liabilities? And although this is a time where other people are probably asking the questions and you're having guidance to do this, my best recommendation when you're past in that due diligence or in the lender underwriting cycle is that you're quick to reply to them, right? Because let's say I recently had I just sold a property and the lender was asking me for this disclosure. Well, I answered that disclosure within the next 24 hours because I recall being in another deal where I did the same thing and I didn't answer him as fast. And then the sellers were just like, oh, look, Frank didn't get back to the lender. So, we got to extend this a little bit further. So you got to be on your toes. You got to be active, and you gotta make sure that you reply in due time when the lender is asking you questions. And after that, I'm sure it's on a deal by deal. There's going to be different scenarios where more stuff may come up. But I think, at least how I look at it, after that, you get approved, then you can go to title, you can go pick up your keys, and then move into your new home or your new investment property. So long as you're prepared, it can be a good process. But if you're not prepared, it can be a very tedious and stressful process. So make sure you talk to people and you're prepared and organized.
And just for our viewers, this is one key area where MPM Strategic Group really helps. We are able to review the contract with you. Oftentimes, people will negotiate these on their own, and they'll miss some of the great contingencies or things to look out for that Frank just mentioned. So if you need some help in that area, we're happy to help. Book a free consultation, and we'll talk more about it.
Well, and to that point, I think actually that's a really good thing on things that you can actually get help from companies like MPM. And, you also have to decide one thing that maybe I didn't mention. You may not do this as your first acquisition, but if you've done a couple, right, you got to protect yourself, And I remember I recently, or a couple years ago, I did an LLC and I had no idea the difference between an S Corp, a C Corp. And, I was so hard-headed where I was like, no, I don't want to pay someone else. I'm going to figure it out myself. Little did I know is I think I did the wrong one, so I had to pay a lawyer. So, no, yes, again, do talk to people like yourself, and I may have a couple questions actually for you afterwards on this.
And, you'll save time, maybe money.
You'll save money for sure.
And at the end of the day, your success is our success. So, anyway, Thank you for sharing some of that detail. So on the vice versa, right? If we talked a lot about the buying process, what if you're selling? Are there any incentives, any tax incentives, things like that people can take advantage of?
Yeah, absolutely. Let me tell you, I've definitely been a little bit more on the buyer side over the last couple of years, and actually on the seller side is where I would encourage people to reach out for help here, because here's where you really can save some money. And again, I'm not a tax professional. Accounting was actually one of my worst classes back in school. But I do know a little bit about some incentives or programs that can save you, significant money, right? And you may be better at speaking for these, but I think, there's things such as a 1031 exchange. I believe it's like a like-so exchange where you can defer tax so long as your next property is equal or more to the previous property that you sell. Doesn't mean you're never going to pay the tax. It's just you're rolling it over. You're deferring it, better said. You're deferring it down the line. And then it's also good to understand what the capital gains tax accounting code, I guess you could say, is. I am not very well versed when it comes to that, but I do know that I think there's a cap or a threshold that until you make X amount of dollars in appreciation, that may be waived or deferred. But again, like I said, it's know who to talk to, right? And be well advised when it comes to that. I know, for example, I just sold the property and I'm definitely going to be seeking for advice when it comes to my tax liability. I think on the seller side, it's not only about the tax liability. You also can think about your options. Remember how we were talking about the broker side? Typically the seller, or at least in the deals that I've done, the seller will pay for the buyer's broker. So that may be, an option where you can do, owner financing. There's a million different options. Granted, I haven't done a lot of those, but there's a lot of options that you have when you're on the seller side that's definitely worth looking into.
Sounds like there's a lot of ways to save money. You can get creative with your deals, and we're certainly happy to help our viewers as you go through this. Let us know, and we're happy to guide you through it. Now, let's talk about something new, something exciting. Innovation. How do you see the impact of emerging technologies, such as blockchain, AI, impacting the real estate industry in the coming years or even today? I know we're seeing some of that today.
Yeah, so this is actually one of the things that really excites me right now, especially in real estate. Real estate has always had a bad, maybe not stigma, but it's always had it hasn't had the best precedent when it comes to technology and kind of embracing new thought. We've always been a little bit of the wild, wild west, especially if you're kind of comparing it to some other industries like investment banking. I feel like real estate has always been stuck a little bit in their old ways. And, for young people like ourselves, maybe not so young in a couple of years, but I think that's another competitive advantage that we have. I'll be honest with you. I feel like I'm good at using Excel and that sort of stuff, but I sometimes I don't appreciate some of the technologies that are in hand. But recently with ChatGPT, I've been really trying to understand it, maybe not exploit it, but use it to the best of my advantage as a tool. And I can tell you that now, I really have ChatGPT on the side of my screen almost at any given time. And you can leverage a couple of those upcoming technologies. I think, like you said, AI and virtual reality are some early on technologies that if you are one of the first users of it in real estate, you're definitely going to see a lot of dividends down the line. Let me just give you maybe one quick example when it comes to ChatGPT. I remember I had a couple architects that were trying to get entitled or we're trying to get one of our projects approved up north. And one of the questions that the city asked was, well, tell me, your building's X height. How tall are all the buildings, or the comparable buildings within a 1 mile radius? And, our architects were like, no, don't tell me I have to go on Google Maps or call the intern to go look at every single property and try and find the heights. First of all, you're not going to find them because a lot of these properties are private. But some of our consultants did the work, and it took them a lot of time to do. And this was actually my first kind of time that I really saw the value in ChatGPT, and I just asked it, hey, can you tell me, buildings that are above X height in this surrounding neighborhood? Granted, it gave me a little bit of a disclaimer, and you have to learn how to talk to it. But, it spat out a pretty accurate finding within a couple of minutes. And I compared that to our consultants, and it was, pretty spot on. I think it was, with an acceptable factor of safety or a delta in heights. So I really think ChatGPT is maybe not the future, but because technology is not my field, but I think it's something that you're going to be, you're going to benefit from if you use it a lot. And then there's the whole other aspect of virtual reality. I think this was people were forced to see this during COVID when you couldn't walk properties. And, I think if you're a broker, that may be a little bit challenging because now I don't necessarily have to go look at a property. But, if you're also on the broker side, maybe use that to your best advantage, right? Maybe you have a client in Turkey that doesn't have the time to come to Miami to look at a property. So send a drone out to look at the views of his or hers new condo and do a video, Yeah, it's sad when I see some of these rental listings in Miami and they just put terrible photos. Like, you can use so much technology to your benefit, and I think these are just a couple of the things. So no, I think emergent technologies is something that really excites me in the real estate industry, and I think it will definitely pay a lot of dividends if you start to embrace it early on.
Absolutely. It's really fascinating to see how it's really reshaping the entire industry. So to close, thank you so much, Frank. I think it's been a great conversation, a lot of value. As we wrap up, just curious to see if you have any closing remarks for our audience or any closing thoughts.
Yeah, no, absolutely. I think, kind of to summarize a couple of the points that I said, or perhaps some of the things that I'm really focusing on, and this is going to be oriented a little bit to Miami. Maybe the first thing that I would say is be conservative. Save a little bit of money. Maybe don't go to that dinner at Komodo on a Thursday. Maybe just cook some food in your house. Budget accordingly, and live within your means. I think it's one that maybe if I wasn't in Miami, I wouldn't maybe say that as one of the first advice, but I've seen that a lot here, especially for young people. So you got to live within your means. And then probably, the last advice I would give everyone right now, especially in a time where, you're seeing a lot of negative headlines and people are not sure what's going to happen. Well, one of the managing directors, he's the guy, actually, the reason why I'm working now at Related Group. And he gave me one of the best pieces of advice that I've ever heard. And that was, be patient, but at the same time, be resilient, right? And what I mean by that is, when I say be patient, I don't mean sit down and wait for the market to correct itself, right? What I mean by be patient and be resilient is that, a couple years ago, maybe I would look at 5 deals and 2 of them would make sense. Well, no, that's maybe not the case anymore. Look at 80 and maybe 2 will make sense. But you got to be patient, and also, maybe don't just go for the first deal that makes sense. Again, be patient, but also be resilient. Keep looking. I know it may get a little bit exhausting, but the more you look, the better your odds are to find something. And, just kind of to that end, I also want to thank you. I think this has been a very interesting conversation with you, and I look forward to maybe coming back in a couple of months, and definitely we'll be listening to a couple of your other guests coming up. So thank you, Mikey.
Absolutely. Thank you, Frank, and thanks to all of our viewers for tuning in, taking the time to learn more about real estate. And keep in mind, if you do have any questions, feel free to reach out to myself. If you're willing to share your info, we'll share it with our viewers as well. And also check out our website, mpmstrategicgroup.com. There's a lot more information there as well, as far as, incentives for taxes, or, information on how to start a business, anything like that. Check out our website, book a free consultation, and we look forward to our next MPM Insights session. Thanks, everyone.